Good morning and welcome, Patriot Radio News Hour. I'm Joe Jaquint, CEO of the Patriot Trading Group, and our toll-free number, 800-951-0592, like you didn't know. AllAmericanGold.com, that is the website. Shout out to Ramon. Ramon does such a great job getting all those articles up there. I will say this. The vast majority of the stuff out there, we never talk about. It's only an hour. We only got an hour. And really, with commercials and all that stuff, we're really talking about 40-something minutes. So make sure there's so much information out there. Our metals plan, if you ever wanted to join our metals plan, it's out there. That information's out there. We put articles Monday through Friday, different articles every single day, videos, all these things. All the podcast stuff is out there. Obviously, our contact information and all that stuff is there as well. AllAmericanGold.com. And welcome to February, right? Probably couldn't get here soon enough. I know Colorado getting ready for a big blast. Winter is here. You're going to see it in the heating bills and in the gas prices as things are picking up out there. Just be careful. I know that Jason is on assignment today. He's doing work for the radio station. He won't be joining us today, but I know that the conditions tonight and tomorrow are going to be a little bit scary. Jason's debating on whether or not he should may have to stay at the radio station overnight, but be careful out there. Be careful out there. I know. Here's the thing. Everybody up there that's been there, you guys know how to handle it and prepare yourselves. If a bunch of Arizonans had to deal with that, it would be complete bedlam out there. So just be a little extra careful. Make sure you get to work and all that great stuff. And I guess there's going to be a bunch of snow coming as well, which I like. We need the water. Water over the next 10 years is going to be an awfully big deal here in the West. We got a lot of things to talk about. Gold and silver are rallying. Gold's back above 1,800 right now, up 10, 11, 1805, 1806. Silver's up 37 cents, 2280, trying to get back to 23. The Dow's up but barely. Dow's up 20 points. A ton of economic data to talk about, but we're going to talk about a few things today. One of them is going to be a little more on the crypto side of things and the regulation that is coming. We're also going to be talking about what China's been up to in regards to crude oil, in regards to computer chips and what that could mean. We're also going to talk about different things in the farming industry, more reports out about how the price of food is going to be escalating significantly. Pork. Apparently the pork stockpiles aren't very good. The Department of Agriculture said the cold storage was down to under 400 million pounds. That sounds like a lot, but apparently, and again, the way we consume meat, that's probably isn't a lot. It is the lowest level in decades. Well, there's a brief moment in 2010, but really looking at these charts here, this is the lowest level of pork in storage in a very, very long time. You eventually get to the point where, the last time it was this low, there was 50, 60, 80, 100 million less people in the country. The USDA is saying that pork prices are on the rise. Bacon hit a new all-time record high of $7, and these are wholesale, $7.21 a pound, up 40%. In the last year and a half. So, all you bacon lovers out there, get ready. This is a big deal for me. I'm on my new diet, by the way. Down almost 27 pounds below. I'm below 300 pounds. I know that's a lot still. But I'm going to get there. I started out saying I was going to lose 75 pounds. Now I think I want to go to 100 pounds. That's somewhere in between there anyway. In this diet, I'm on this keto thing, which for me works. It's the first one, and I've tried a few different, I've tried, the celery juice diet. That did not work for me. I've done the walking thing, which I had some success with that. But this keto thing, for what I like to eat, seems to fit what for me anyway. Bacon, a big part of that, because my wife, I didn't get to eat a lot of bacon, but yeah, it's going to get a lot more expensive. Thinking of expensive, we haven't talked about this one. Again, it's going to be everything. I just want to try to drill this home to everything. It is going to be everything. Cotton prices hitting more than a decade high as apparently, like everything. Cotton prices expected to go significantly higher. Here's the funny thing. Cotton was $1.26 a pound, which I don't know. That sounded cheap to me. But apparently they're saying that cotton has been up for 7 straight quarters in a row, the longest streak going back to 1959. And they're talking about cotton going to $1.50 a pound. And here's what was so funny about that is one of the people they were talking about in the interview, they said May and June future prices at $1.50 a pound. That is no man's land in terms of cotton. And the traders are like, we don't even know what to do with it. Here's the problem. I don't think it stops at $1.50 a pound. Yeah, those shirts are going to start costing more as well. Patriot Radio News Hour. We'll be back after the break. 800-951-0592, Patriot Radio News Hour. How bad is it going to be? Yesterday, and I apologize, I know our stream was down at 1360. It's back up. But yesterday we talked about, we got a big piece of the puzzle we were missing. The Freedom of Information Act. And I want you to understand how malicious this really is. There's laws in place. There's, rules in place when it comes to our central bank that they're allowed to block access to what they're doing for 2 years. And then you can, through the Freedom of Information Act, tell us what you did. We have a right to know. Well, apparently we really didn't. When it came to the financial crisis, the Fed went all the way to the Supreme Court to argue that, hey, if we actually told people what we did, that it would be horribly damaging. Horribly damaging to who? Right? It would be horribly damaging to the system that they've created, and which is why we talk about this house of cards. Understand what's happening here. So yesterday we learned how much money they really created. Today, if I don't get it through today, I'll do it tomorrow. I'm going to start showing you how much more money got created starting in 2019. We talked a little bit about 2019 when the Fed, remember, the Fed was tapering, and they had to have that dramatic reversal. We're going to share that as well. But this is why when we talk about what we're facing here, think about, have I missed anything? Anything that we can consume? And the prices, how about this? Rent. Now, as all of us know, we are a nation of renters. We're right at that point where about half the country rents. Right? Think about car leases, right? For most people, that's all they do. They just rent. Rent prices skyrocketed across the country. They're saying that the average rent rose 14% last year. Now, we know home prices rose 20%. The Fed, they're saying that, the rent equivalent, that rent equivalent they use for inflation, they're barely at 4%. And the problem is this number, this number, that makes up the biggest part of CPI, which is why it is very advantageous for the central bank to lie about the number. Because if they actually just use the rent number, 14%, because it's easily tracked. I mean, that's what it was. The inflation number that they say was 7% would be 20. I mean, think about what I just said, 20. Let's go through it. Cities like Austin, New York, Miami increased what it was as high as 40%. Phoenix, by the way, all you Arizona listeners, Phoenix, we didn't have one city in the top 15. We had 5 cities in the top 15 as far as rent increases go. Rents really shot up in the second half of the year, but here's the bad part. According to real estate firm Redfin, they're saying that rents are going to continue to rise in 2022, saying expect at a minimum another 10% increase this year. And again, I want to point it out, it's not going to stop. You have no idea. People have no idea. It's going to be a very, very rude awakening. And then I wanted to share this story as well from Michael Snyder. If you guys don't follow Michael Snyder, he does the economic blog. He's really good. He does a lot of great blogs out there. He is saying that he had a farming insider reach out to him. Now, he doesn't name the person. So I don't know if this is a major buyer, right, like processor of fruits and vegetables or corn and soy. I don't know if this is a trader, right? Is this somebody that trades in the farm commodities, or is this somebody tied to the Food and Drug Administration, or it has ties to the Department of Agriculture? But I want to share with you an excerpt from the email he sent to Michael Snyder. Things for 2022 are interesting. And then he puts in parentheses, and scary. Input cost for things like fertilizer, liquid nitrogen, and seeds are like triple and quadruple the old price. It will not be profitable to plant this year. Let me repeat. The economics will not work. And the word not was in all caps. Our plan is to drop about 700 acres of corn off and convert them to use soybeans. Now, I talked about this, I want to say a week and a half ago. Soybeans require less fertilizer. Remember now, so this means the price of beef, because they use corn, the price of gasoline is going to get much more expensive because the corn harvest is going to be significantly less. Farmers know how to do math. Farmers are probably the best at economics, and not because they want to be. They say that soybeans use less fertilizer. And we also have chicken manure from that operation. Guess what, he says, or writes? We are not the only ones with those plans. So this is obviously, now that I'm reading this a little more carefully, this is obviously a major grower. Already, there is a shortage of soybean seeds. What? It doesn't end, does it? It's like everything. So we will see how that works out. Well, I can tell you how it works out. Right? The cost of the soybeans are now, the seeds are going to triple and quadruple and possibly more. The way I see it, there's going to be a major grain shortage later this year, especially with corn. I mean, we are small with that. What about the people in the Midwest who have like 10,000 acres of corn? This will not be good. Says that the plans for most of the farmers out there is to drastically cut the corn acres. And again, you guys can do the math. You guys can understand what is coming. And why do I bring this up? Because I've been telling you all along, you really have no idea what's coming. What got dropped yesterday in the Freedom of Information Act of how much money the central bank actually created during the financial crisis. So go back 08, 09, 2010, 20, and really kept creating secretly for years. Trillions. Trillions and trillions, and I'm not talking about 5 trillion, 10 trillion, 20 trillion. Right? We're talking hundreds of trillions of dollars, and now it really makes sense. And you think about every industry has the same problem. I can't produce this because it's too expensive. I'm going to switch to this. And then all of a sudden you switch to that. Now it's like, wait a minute, I don't have enough seeds for that. So I can't produce, right? If I can't produce that, what's the, and it's like this daisy chain of events. And next thing you just end up with sky high prices on everything. People not being able to afford to live. You're talking about, there was an article on the local news yesterday, and I was watching it on accident. Right, that it was on that channel. I wasn't even watching it, but I hear this thing about rents. They're talking about rents going up as much as $800 a month. They interviewed one young lady who's being interviewed. She's like, "Yeah, my rent jumped another $300, and already I was living paycheck to paycheck." And I don't know where I'm going to live. And this is kind of the thing that I think all of us are going to face in 2022 into 2023. This is why the recession lights are flashing. The Fed is not going to be able to get away with a couple of rate hikes and calling it good. That's not going to work. So I think Wall Street is in big trouble coming into the end of 2022 and into 2023. I think probably, this is my guess, we're probably in for a big recession, I think, in 2023. That's just my guess. And again, we'll see how creative the Federal Reserve is going to be. But I want people to understand what's happening right now through the Office of Financial Research. This was an office created by Dodd-Frank. And again, I want to emphasize how this bill is going to punish us all. This was Wall Street on parade. I got to tell you right now, quickly becoming one of my favorite places. And again, this is really complicated stuff that isn't that complicated. But the Dodd-Frank bill created this department for the government to warn. It was supposed to be an early warning system for the derivatives market, really, which was to warn us, hey, these banks, they're doing that risky stuff again. And Wall Street on parade is kind of calling them out. Apparently, the report they released July of last year, which so funny is the Martins didn't. The Martins are the one that does Wall Street on parade. They didn't even discover this until last week. So again, the the hiding of documents that is, whether it be the central bank, whether it be this agency that they made this big deal about how this was going to make us all safer. Remember, I've told you, Dodd-Frank actually puts us at a bigger risk. And that was really their intent. Hey, next time, you made yourself clear, America. You don't want us to bail the banks out. Okay. Well, we'll make you pay for it next time. That's really what Dodd-Frank is. And then they made the banks even bigger. But the report, if you want to look this up, counterparty choice, bank interconnectedness, and system risk. Sounds complicated, right? I don't want to read that. Let me just tell you what that really is. This is these derivatives, right? Remember the CDSs and the CDOs and all these swaps and all this stuff we learned about during the financial crisis. This is all the stuff on banks' balance sheets that, remember AIG. So they had quote-unquote insurance. And then, of course, all the insurance companies that were insuring these derivatives went belly up, right? So the insurance wasn't even worth the paper it was printed on. Well, the Martins uncovered something really nasty in here, and you all need to understand it. Because remember, I've been warning you about having your money in the bank for forever. This is the reason why. We'll be back. 800-951-0592, Patriot Radio News Hour. We're starting to understand the depths of what the central bank and these mega banks have been hiding. Of course, it's 10 years too late. But now the problem is even worse. I want to reiterate. This is the Office of Financial Research. Again, created by Dodd-Frank to monitor these risky derivatives. That, the funny part is they created these derivatives and said, see, we've minimized the risk. No, they actually made it much greater. But here, I want to, and also one other thing, quick note. This was done in July. Think about a little before that. Remember, after the Fed had to have this emergency in 2019, it was this market they were bailing out, by the way. They prevented banks from paying dividends. They prevented them from buying back their own stock. I don't know if a lot of you remember that. And then all of a sudden they said, oh, problem's fixed. And, of course, all the banks started increasing dividends, right? Buying back billions of stock. Come to find out, this arm that was created to be kind of the whistleblower was blowing the whistle to absolutely nobody. Let me read you. So the researchers, they examined 18 different over-the-counter derivatives. Okay, so this is going to be housing, probably commercial real estate, probably multifamily housing, automobiles, probably credit cards. I mean, all kinds of stuff. 18. And now, I don't know if that's all of the categories, but they did 18 of them. And I'm going to imagine, because I want to believe that they're trying to do a really good job, that they did the 18 biggest ones. Okay, so, but they did 18 of them. I want to read to you what they wrote. Banks' interconnectedness through the over-counter derivative markets was identified as an important factor that contributed to the severity of the great financial crisis. Okay, let's face it, it was the reason, right? I mean, it was it. And it remains an area of fragility of systematically important banks on which we have very limited understanding. Right? Again. What? Well, we still don't know what these things are. I don't talk about Warren Buffett a lot, but one of the reasons why he was kind of unscathed in the financial crisis is because he goes, people try to sell me these derivatives all the time. And then I'd ask them to explain it to me, and they never could, and I couldn't understand it. And if I don't understand it, I don't buy it. Well, apparently, the office that we created to monitor this stuff has said, man, we don't understand it. The trading of these derivatives is notoriously concentrated in the largest banks, which are also the ones for which we have data. Okay, so we learn one thing. The major banks pretty much own this market, and that makes sense, right? The largest banks, the 10 largest banks, got 90% of all the deposits. My guess is these largest banks got 90% of all the derivatives. And by the way, these were the banks they were looking at, so we know that. One important feature is the substantial counterparty risk that banks face. In our context, the most important counterparty risk is that faced by banks trading with non-bank entities. So very interesting. Wait a minute. What are they saying? Non-bank entities. See, before, right, they were trading with like AIG, and technically the insurers, and of course we know what happened, they all blew up. But according to the office here, the Office of Financial Research, the bank has found a new patsy. And this is where it gets interesting, because the Martins ask, so they get this information. They call the Office of Financial Research. They talk to the researchers that actually did the investigation and ask them, hey, will you tell us who these non-bank entities are? And according to the Martins, they got no answer. They refused to tell them who the counterparties were, other than saying that they were non-bank entities. They did tell us that the banks that are at most at risk, the Wall Street mega banks of JP Morgan Chase and Citigroup, Bank of America, Goldman Sachs, these are the ones that are listed in this report. We know that banks, in the report, we know that banks are more likely to establish or maintain a relationship and increase their exposure within an existing relationship, the report says. So in other words, what they're saying is, hey, once the banks get one of these non-banks to bite, seemingly what the data tells us is they continue to overwhelm the non-bank counterparties that already have heavily connected and exposed to other banks. In other words, all these banks are dumping this stuff on the same non-bank entities. So again, hugely risky. This is just like, hey, AIG is the counterparty to all of this. Right, and according to the researchers, they're like, this is the same problem, just a different patsy. And the problem is, I'm assuming this is going to be a bunch of Wall Street companies. That's my guess. Right, that are desperate. Got to remember, they're desperate to do something with this money. Normally, they would have bought treasuries. Right? The same reason we talked about, why are the banks in the housing market? Well, they can get 5% after everything's said and done by collecting the rents, and after they pay the property management and fix all the stuff and this and that. Where before they just would buy a treasury and say, I can make 5% and I don't have to deal with all the headaches. Same thing happening here. The house of cards. Is it getting ready to implode? Patriot Radio News Hour will be back. 800-951-0592. I'm reading from a report from the Office of Financial Research. This was done July the 12th. This is when the report got released, July 12th, 2021. Remember, this is after this emergency, before coronavirus. The emergency where the central bank had to open up the Fed window for these financial derivatives, if you will. And then signaled, we fixed it all. And banks can do what they want again. Everything's wonderful. And according to the office, again, created by Dodd-Frank to warn about these things. Let me go back to it. So here's what they said. The banks have found a new patsy. And again, remember, when the counterparty fails, the bank fails. Right? Because the banks are relying on this counterparty, right, to pay if the derivative doesn't succeed, right? If the derivative basically goes under, right? They're the other side of the trade. We learned the first time around this was heavily done in insurance companies or reinsurers. The Office of Finance here says, okay, they found a different patsy. But here's what we found. We have the same exact problem. There's not that many of them. All of them, these non-financial, but non-bank companies, they're buying huge quantities of these, and they're buying them from everybody. Right? There's that interconnective thing. Hey, we got a big problem here. So let me read to you what they say. They said, in such densely connected networks are more likely to connect with riskier counterparties. In other words, as this goes on, every day, day after day, week after week, month after month, the trades get more risky, which makes sense. Hey, there's too much. You can't spread it out enough, and now you're selling more and more risky assets all to the same people. And they're saying that riskier counterparties for their material exposures, the effects are strongest in the case of non-bank financial counterparties. The findings suggest moral hazard behavior and counterparty choices. What does that smell of? Hey, we're dumping real stuff we know is not going to be good onto these guys. And they're not smart enough to realize what we're doing. Right? Isn't that disgusting? Of course. Finally, we demonstrate that these exposures are strongly linked to systemic risk. Overall, the results suggest a network formation process that amplifies risk through non-bank linkages and opaque financial markets. Yeah. Here we go. Again, this is the blow-up. This is what's going to happen. But this time, the blow-up isn't going to be AIG. This time, the blow-ups are going to be, I'm guessing, a bunch of our stalwarts of Wall Street. This is going to be a double whammy. Here's the sad part. They refused to name any of the banks and any of the non-banks in their report. So I misspoke because I told you, hey, Citi, B. The Martins are saying that through the research, these are the ones that have the highest exposure. But the report from this regulator refuses to name any of the parties involved. How are we supposed to know the risk if you won't tell us? Now, here's what the Martins did. Going back to October 1st, 2019, the largest borrowers in the Fed repo loan from October 1st of 2019 through December 31st of 2019. So think about that. That's like 3 months. Nomura Services, $3.7 trillion. JP Morgan, $2.59 trillion. This is the money they were borrowing. Goldman Sachs, $1.67 trillion. Barclays, $1.48 trillion. These are trillions. Citigroup, $1.43 trillion. Deutsche Bank, $1.39 trillion. This is 2019. And they just have 6 banks. There's over $10 trillion right here. I wonder how bad it really gets. They say the larger the bank, the greater potential spillover if it defaults. The higher its leverage, the more prone it is to default under stress. And the greater its connectivity index, the greater is the share of the default that cascades onto the entire banking system. I think I got the plan. This is how the digital currency is going to come. Patriot Radio News Hour, final segment coming up. 800-951-0592, U.S. $10 Liberties, $1,045. If you buy 10 or more, $1,040 at 800-951-0592. Gold's up a 10 spot here, 1805. That's obviously a little healthier here after the ridiculous sell-off that we saw last week on a bunch of Fantasyland nonsense, by the way. Silver's up almost 40 cents. Crude oil, $88 and change. Keep an eye. That market is going to get even bigger, but we're talking about the risk here. By the way, they did mention Citigroup and JP Morgan by name in this report as far as they have the largest foreign assets in the derivatives. In other words, the failure doesn't even necessarily have to occur here. Now, they don't say what countries or what, who or where these foreign assets are. All as they mention is that the 5 U.S. banks had large foreign assets, and when they consider large to be more than $300 billion, but they did mention J.P. Morgan and Chase have substantially more than that. Then they also went on to say that this risk is completely systemic. We've got the same thing happening again. It's going to happen all over again. Inflation is roaring. We haven't even seen the worst of it, which is the bad part. When the interest rates start rising, you're going to see these things start buckling, and then this cascading event, and of course they're talking about winding down their balance sheet. That's all fantasy land. It's not going to happen, and if it does, it's going to be done deliberately to crash this whole thing together. And I want to point out that the Federal Reserve has worried enough. They have given oversight, supervision, to companies, J.P. Morgan, Citi, Goldman, Morgan Stanley, all these guys. You know who they put in charge of supervising these guys? The Federal Reserve Bank of New York. I mean, this is something where, quite honestly, this is the power of banking. There's no way. This is classic let the wolf guard the hen house. This is nonsense. This is absolute nonsense. This is why we need somebody completely independent. But here's the problem. You know, what they say, well, you know, these people, these independent, we can't use independents because they don't understand. This is complicated stuff here. It's not complicated. You're putting risk onto companies that have no chance to pay it if it goes bad. And you've connected it all. We understand it all. I want to just praise the Martins here for uncovering all of this. And I want to point out the Freedom of Information Act that we got the other day that exposed, you know, hundreds of trillions of dollars of money created. Just think about how much money the Fed created in the last 3 months of 2019. This is why. Food shortages, right? Sky-high prices, all of these things. It's all tied to the creation of money. You can't have prosperity from the printing press. Well, you can for a little while, and then it all comes crashing down. $10 liberties, 1,045. 10 or more, 1,040.